Bill Gross, kind of you to join us this afternoon. Bill Gross, I want to talk about the dollar. And you and I remember the days where we would trot out, we need a strong dollar policy. Here's the immovable fact. Since the Trump administration has gotten into trouble, we've enjoyed a weak dollar policy. What does that weak dollar signal?
Well, I think a weak dollar policy plays into the hands not only of the administration in terms of allowing manufacturing to be more competitive, but it plays into the hands of the Federal Reserve. The Fed, Tom, wants 2% inflation. They mentioned that in their statement today, very significantly. They basically said the committee is monitoring inflation developments closely. And so, they want a 2% target. They want it to be hit as quickly as possible, and a weaker dollar plays right into their hands. There have been estimations that a 5 to 10% decline in the dollar, and we've seen a 7% decline since the top, reduces or increases inflation by 0.1 or 0.2% a year for the next several years. And so, it's very much of a favorable development for both sides of Fed and policymakers.
I want to emphasize, Bill, if I went down to Duke University right now and had to do Chart 101 for the students at Duke, what I'd be talking about is a perfect dollar chart. Bring it up, Tanya, if you would. This is the gorgeous Bloomberg Dollar Index. This is actually very good mathematics in terms of a blended dollar rate in all those little circles. For those of you on radio, it is the mother of all elegant charts. And now we crater down even more into weak dollar. What does that weak dollar mean for other central banks? Is this a way for the Fed to compete with rate increases, or at least the discourse of rate increases at other banks?
Yeah, I think it is. It's probably a stretch, Tom, to say that there's a currency war going on, but certainly central banks are, well attuned to their currency levels. The Fed basically ranks it 4th or 5th down their list, but I know that they're looking at the currencies I just mentioned, and at the ECB with Draghi, they specifically look at it in terms of a strong or a weak euro. You mentioned a strong euro in the last 10, 15 minutes. That's really not in the favor of the ECB and the stimulation that they want to see in terms of reaching their own inflationary target of 2%. And so do we have a war going on? I wouldn't call it a war, but it's certainly a skirmish. And the BOJ as well is in the fight, so to speak, because they've kept their policy firm at the 0% in terms of the 10-year interest rate, and they don't seem to be moving off of it at all. So, yeah, central banks are very much concerned with reaching their own inflationary targets by the basis of a lower currency.
Yeah, the Fed is, of course, looking at currency levels. It's also looking at making sure it's prepared in the next downturn. You told me last week, Bill Gross, that a growth slowdown or a recession would actually do this economy some good. It would help clear out some of the dead wood that's out there. In which asset classes do you see signs of dead wood?
Well, you don't see it yet. So you saw it for a while, Scarlett, in the oil patch when oil was down near $40, and some of the oil-related companies in the U.S., were highly levered and were beginning to look a little bit more risky. I would say, though, that the U.S. Corporate market is more highly levered than it was, during the Lehman recession, and that should higher interest rates, come into view, that a recession, if only based upon corporate profitability and the potential for weak corporate defaults, come into play. So it's not there yet, but certainly the Fed wants to keep the economy at a 2% level. My remark a week ago, Scarlett, was basically saying that there's a lot of dead wood in the marketplace. There's a lot of zombie corporations that, in terms of Schumpeter and so on, creative destruction. There's been lots of creation in terms of credit, but not much destruction of inefficient credit.
Got it. You also urged, Bill Gross, that the Fed proceed with caution, saying that the yield curve doesn't need to flatten to the extent that it has historically for growth to slow down. So is there anything the Fed should do differently than what it's doing now, or is it taking the correct approach?
Well, I think they are beginning to take the correct approach. Let's look at it this way. Short-term Fed funds at 1.25% now. incredibly, in my view, are approaching a new normal level, according to Fed research, which posits 0% real rates over the long term, maybe something a little bit less. What the Fed is more concerned about now is the steepness of the yield curve. They want to promote higher bank profit margins with a steep curve and avoid recessionary dangers of keeping the 10-year spread around 90 basis points or so. They don't want it flat, which has produced recessions in the past. And so I think the Fed, therefore, will stop raising short-term interest rates, maybe 25 basis points, maybe not, and start disinvesting in 10-year treasuries that they mentioned in the statement by reducing the balance sheet over time. And that means, to me, slightly higher 10-year rates, perhaps to 2.5% over the balance of the year, but not much.
Bill, you've always been a student of our politics. With your success over the years, you've done things like donate to your Africa Mercy hospital mission in Africa. You made headlines with me worldwide not so long ago about our president and philosophies of fascism. It was really remarkable what you said. We need an update today with what you're seeing out of Washington in political economics, with what you're seeing out of the discourse of the president. Do you have a concern about the path forward for Washington? We do this with a press briefing waiting, all the rumors about the Attorney General. I need to hear right now an update from Bill Gross on the certitude that this president has.
Well, let me speak to that comment. I mean, when I spoke about the potential the flavor of fascism, I basically meant, the standard definition, which is basically government basically controlling corporations. And when Trump early on, spoke about controlling corporations and having them do this or that in terms of Mexico or staying in Detroit, basically it was a more intense type of movement towards telling corporations what to do. I don't think that's gone to more extreme levels, but the unrest in Washington certainly is a situation that is unusual, is it not? And that bears watching in terms of risk spreads and in terms of stock prices.
Right, Bill, then finally here, with Janus Henderson's clients and with our listeners and viewers worldwide, do you believe that the events of Washington, the uncertainties of Washington, can fold over into your bond market?
I do. Obviously, that hasn't happened yet. It hasn't happened in the stock market. It seems to, just fly over the heads of investors that are in one ear and out the other. The biggest risk I see, Tom, and I don't know how to measure it, I'm sure you don't either, is a geopolitical risk. I think that risk spreads are so low, the VIX is so low, the TY VIX as a measure of bond volatility is so low that there's really not a geopolitical risk measured into that. We're at historically low levels. And what would the risk be? We can't say, can we? North Korea, China, Syria, the Middle East, Russia, but something might happen geopolitically that would stir this market one way or the other and produce higher risk as opposed to lower risk, which, as I mentioned, is at historically low levels.
Bill Gross, thank you so much. Generous of you to be with us on this Fed Day. He is with Janus Henderson.